If you're viewing this presentation, that means you've completed the two comprehensive problems in Section 3. Let's go over the solutions to those problems now. Problem 3-1 presents you with a series of equity transactions for MI Air Incorporated in 2017, its first year of business. You're asked to journalize the transactions, present the effects of the stock transactions on MI Air's 2017 income statement, and to report stockholders' equity on the company's December 31, 2017 balance sheet. First, let's see what we can do with journalizing the transactions. On January 1st, we issued 200 shares to an investor for $8 per share. So we would debit cash for the 200 times 8, or 1,600. We would credit common stock for the par value, or $1, and the difference would go to additional paid-in capital on common stock of $1,400. On December 1st, 2017, we purchased 40 of the shares that we originally sold to the investor for $10 per share, and we placed them in the corporate treasury. We record treasury stock at cost, so that would be the 40 shares times 10, or $400, and the difference would go to cash. We're paying cash of $400. On December 10th, we issued 75 shares to another investor at $9 per share in order to secure additional financing. Similar to transaction 1, but now at $9 per share, we would debit cash for $675, which is the 75 shares at $9 per share. We would credit common stock for the par value of 75, and the difference would go to additional paid-in capital on common stock, $600. On December 12th, we issued 30 of the treasury shares when the market price was $11 per share. So we're receiving cash of $330, which is the 30 shares times 11. We're crediting treasury stock for the cost, or $300, and the difference is going to additional paid-in capital on treasury stock of $30. On December 15th, we declared a 20-cent per share dividend. We would debit retained earnings for the $53, which is the 20 cents times the outstanding shares, and we would credit dividends payable for $53. And finally, on December 31st, we paid the dividend declared on December 15th, so we would debit dividends payable and credit cash. So you may be wondering how we came up with the $53. Well, remember, we only paid dividends on outstanding shares. So you have to go back to the very first transaction and work your way down until you come to the dividends. Remember, on January 1st, we issued 200 shares, and then on December 1st, we purchased back 40 of those shares. So it would be the 200 minus the 40. But then, on December 10th, we issued 75 more shares, and on December 12th, we issued 30 of the treasury shares. So if you take the 200 minus the 40 plus the 75 plus the 30 and multiply that by the 20 cents, that gives you 53. Problem 3-1 continues by asking us to fulfill the requirements 2 and 3. Requirement 2 is to present the effects of the stock transactions on MI Air's 2017 income statement. Well, fortunately, the only impact on the income statement is to report the $200 of net income that's presented to you in the problem. All other accounts are balance sheet accounts. Requirement 3 says to report stockholders' equity on the company's December 31, 2017 balance sheet. That would look something like this. In our contributed capital section, we would have common stock $1 par, 275 shares issued, and 10 shares in treasury. That gives us 275. Additional paid-in capital on common stock is 2,000, and additional paid-in capital of treasury stock is 30. So we have total contributed capital at December 31, 2017 of 2,305. For retained earnings, we end up with 147. How is that calculated? We took the $200 of net income and subtracted out the $53 of dividends. That's 147. Then we subtract the treasury shares of 100, leaving us with total shareholders' equity of 2,352. In problem 3-2, you're presented with some excerpts from the balance sheet of Subtle Edge Incorporated. You're also given some information related to the risk-free rate of return, which is 3%, the risk premium, 4.05%, and the tax rate of 30%. You're then asked to compute Subtle Edge's weighted average cost of capital. First, let's look at the cost of debt. The cost of debt is nothing more than the annual interest divided by the total liabilities. The annual interest is calculated at $116,000. How? We took the $200,000 of notes payable times the 8%, and that gives us $16,000. Then we take the $1 million of bonds payable and multiply that by 10%, and that gives us $100,000. So it's a total of $116,000. And then we divide that by the $1.2 million, which is the total liabilities, and that gives us 9.67 on a pre-tax basis. If we take that 9.67 and we multiply that by 1 minus the tax rate of 30%, that gives us 6.77% on a net of tax basis. The cost of equity is nothing more than adding together the risk-free rate of return of 3% and the risk premium of 4.05%, leaving us with a cost of equity of 7.05%. The percentage in debt is the 1.2 million divided by the 1.850 million, or 64.9%. The percentage in equity is the 650,000 divided by the 1.850 million, or 0.351, 35.1%. To calculate the weighted average cost of capital, then, we take the percentage of debt of 0.649 times the cost of debt, 6.77, and we add that to the percentage in equity of 0.351 times the cost of equity of 7.05, and that gives us a total overall cost of capital of 6.86%. That's 4.39 plus 2.47.